Well, that's a perfect segue into Mark. Why don't you talk a little bit about the debt markets? We'll get to the equity side, but let's talk about is liquidity back? What are you seeing out there?
You know, it's interesting because you really have a bifurcated market. You have a lot of folks who started out when money came back into the marketplace, let's say, on the debt side, call it 18, 24 months ago, and what the favorite child was apartments. Across the country, you know, apartments, and then the equity flowed to apartments, and they had a lot of that going on. As that kind of matured, but it's still going on, but as that kind of matured, you started flowing toward industrial. And there was money for industrial, there was debt for industrial, there was equity for industrial. And so what's happening is that the portfolios are beginning to be full of those kinds of assets. So what does that leave? What's next? What's the panelists that are sitting up here? And what's going to happen is you got some people, then the next flow goes to the retail sector of the marketplace. There's some hotel money out there, but there's some talk now about repositioning, reallocating toward retail. The problem is you've got two segments of that going on. You've got the guys who are saying, okay, we want to manage our portfolio in terms of money we're putting out, and we're going to go to retail. And then you've got the others that Sandy talked about that said, we're not quite sure that the consumer confidence and the sales are going to support the retail values that are out there. So you're not going to have the whole marketplace move toward you, but you're going to have about half the marketplace move toward you with respect to the availability of capital. On the one side, you've got the insurance companies. The insurance companies have their own problems right now. The insurance company problem is the rates are too low. And they go off of something called ultimate reinvestment rate. And the ultimate reinvestment rate means that if I have to put this money back out, I have to go sell an insurance policy. And the money that I bring in has to be able to pay for the cost of my insurance policy. I have to match my liabilities and my assets. Well, when you start looking at it and you go, okay, it costs me to manage this, the life companies, 1.5% to 2%. Then they've got to return some money to the policyholder. They've got to return some money to the equity holder. And all of a sudden, they can't make 4% loans and stay viable. So what you saw at the early part of this year with the insurance companies coming back into the marketplace and having capital available was because the rates were somewhere in that 5 and they could get to that. As the rates have come down, the insurance companies have pulled money back off the table because they can't now they have investment income that's coming from other sources that has allowed them to sustain themselves for a while. But you're going to see the second part of this year kind of a tightening up probably on the insurance company side. That's a big window for all of the. Is there some CMBS guys out here in the market out here? You're going to see some CMBS guys taking advantage of that because the competition for the product is going to lean. And if you want to borrow and you want to borrow at higher leverage levels, and you want to buy very very competitively, you'll probably tend toward more CMBS debt in the next 6 months to a year.